Stocks are now kicking off November in the green. Historically, stocks have ended the month on a high note. So can investors count on a bullish November? Let's bring in Omar Aguilar, Schwab Asset Management CEO and CIO. Omar, we're going to get into stocks in just a bit, but let's sort of dovetail on what Jen was just talking about, because we are awaiting that Fed decision this afternoon. In many ways, bond yields certainly have become the focus here because they have guided the Fed along, at least in this next step. How are you viewing the moves, particularly on the 10-year, and can these levels be sustained?
Well, we've been discussing this with clients and internally here that, for the last 18 months, the bond market has actually been the driver of most of what's going on in equities, as well as what's going on in just parts of the economy. The lift that we have seen in yields and the volatility of yields is unprecedented. Just the moves today, when you actually see that yields just drop, by 15, 20 basis points in a single day, those are by historical standards pretty high. I think, the biggest part of these obviously has to do with, where the end rate decision will be by the Fed. And while the market seems to be comfortable thinking about that there will be a pause today, there seems to be a disconnect between Fed expectations on what they think they want to do based on their dot plot and what the market seems to be thinking. And they're still in this disconnect that creates this amount of volatility for bond yields, and as well as, that translates into volatility to equity market.
So with that in mind, then, you note that higher bond yields, a resilient job market, and then slower wage growth, giving the Fed several options on the table. As we're coming off this 3-month losing streak for stocks, then what does that signal then for November? What should investors expect?
Well, it's a great question. On one hand, the Fed seems to be in like this Goldilocks scenario where things are just working as they cannot be better. I think if you think about the job that they have done, while inflation is still uncomfortably high for their expectations, and their comfort level of getting to that 2% in the near term seems to be a little farther away, the economy continues to grow. The consumer continues to be very resilient. They see that the labor market is not necessarily weak enough for them, but it's in a pretty good shape. And the equity market, yes, with a small breath, we can see that it's still holding up pretty well. So when you put all this perspective, the expectation for the remaining of the year is that as long as the economy and the labor market and the consumers stay resilient, then we will probably see a little more stability as the Fed gets closer to the end of their tightening cycle. I think earlier when you were discussing, yes, the level of yields and the quantitative tightening by the Fed and other central banks, in a way, they're doing the job of actually creating that more restricted monetary policy. And therefore, as long as that gets a little more stable, we can actually see equity markets and risky assets be a little less volatile.
Omar, let's talk specifics in terms of strategy. You specifically highlight strong balance sheets and healthy profit margins as key in terms of names you're looking at. We're right in the thick of things in earnings. Who's impressed you so far?
Well, it's clearly this is the area where we tend to advise clients not to be heroes. In this particular case, there's still a lot of uncertainty or where things are. So far, the discussion about an economic recession seems to be far away. Not everybody's talking about recession anymore, but, we're still not out of the woodwork. We still have a tightening, mechanism, lower liquidity, higher volatility. And while we have been on the camp that parts of the economy are already in recovery mode, we expect that we're still going to see significant amount of potential, risk on the markets. And therefore, as you described, we continue to emphasize quality both on equities and fixed income. Higher quality, meaning, companies with strong, balance sheets, companies that tend to have, good profit margins, tend to have good earnings revisions, and companies that tend to have, in general, a good earnings growth. And again, that tend to actually end up being more paying dividends as opposed to actually, trying to, take a big multiple. So that's a big part of what we focus on, both equities and fixed income, as we believe we're still going to have some levels of volatility and lower liquidity going forward.
We'll certainly be tracking all of that. Always great to have you on, Omar Aguilar, Schwab Asset Management CEO and CIO. Thanks so much.